Only people who truly understand banking history realize this. Wells Fargo didn't just survive American financial history, it helped shape it. And yet, it also became one of the most controversial banks of the 21st century. So how does a company go from carrying gold in stagecoaches to paying billions in penalties to having growth restrictions lifted in 2025? That's what we're breaking down today. In 1852, during the California Gold Rush, the United States wasn't just expanding geographically, it was expanding economically. Gold was being pulled from the ground, fortunes were being made overnight, and entire cities were forming instantly. But there was one major problem. There was no safe financial infrastructure. If you struck gold, how did you protect it? If you earned money, how did you send it home? That's where Henry Wells and William G. Fargo stepped in. They built a system for moving value through dangerous territory. Gold, mail, currency, important documents. And that reputation for reliability became their first real asset, trust. As the American West expanded, Wells Fargo expanded with it. What started as gold rush support evolved into full banking services. Branches developed across the country. Brand recognition grew. Expansion wasn't just geographic, it was structural. Fast forward to the late 20th century. American banking entered a consolidation era. Mergers reshaped the industry. Banks combined balance sheets, technology systems, cultures, and leadership structures. Wells Fargo wasn't on the sidelines, it was aggressively expanding. In the 1990s, when many customers still distrusted the internet, Wells Fargo embraced online banking early. That innovation mindset helped it compete nationally and scale quickly. Growth accelerated, and complexity increased. By 2010, Wells Fargo had become one of the top 3 banks in the United States by assets. It was seen as stable, powerful, dominant. But giants carry pressure, and pressure tests culture. In 2016, regulators announced enforcement actions that shocked the industry. Millions of unauthorized deposit and credit card accounts had reportedly been opened without customer consent. And this wasn't just about rogue employees, it was about systemic incentive pressure. Employees faced aggressive cross-selling goals. Incentives were tied to product volume. Over time, pressure distorted behavior, trust eroded, and public confidence dropped dramatically. Media coverage intensified. Congressional hearings followed. Customers questioned the integrity of the institution. Wells Fargo's brand, once built on trust, was now associated with scandal. In 2020, Wells Fargo agreed to a $3 billion settlement with the Department of Justice and the Securities and Exchange Commission. This resolved criminal and civil investigations related to sales practices. $3 billion, accountability on a historic scale. In 2022, the Consumer Financial Protection Bureau ordered Wells Fargo to pay $3.7 billion over issues involving auto loans, mortgages, and deposit accounts. The narrative expanded beyond sales practices into broader governance concerns. But perhaps the most unusual action came from the Federal Reserve in 2018. Instead of just a fine, the Fed imposed an asset cap, limiting Wells Fargo's ability to grow until governance improvements were made. Growth was restricted, corporate restructuring followed, compliance costs increased, leadership changed. For years, Wells Fargo operated under a regulatory leash. Then in 2025, after years of reform, the Federal Reserve lifted the asset cap. Regulators acknowledged improvements in governance and risk management. This marked a major turning point. Not perfection, but progress. When you zoom out, 5 phases define Wells Fargo's story. Founding in chaos, expansion through mergers, digital transformation, scandal and governance crisis, recovery and reform. Phase 1, building trust during uncertainty, delivering gold safely, protecting value, establishing reliability. Phase 2, scaling nationally, strategic acquisition strengthened market position. Brand consolidation created dominance, but scale increased complexity. Phase 3, innovation, early online banking, digital transformation, customer convenience expanded nationwide. Phase 4, when incentives outran controls, sales pressure, governance breakdown, regulatory enforcement, reputation damage. Phase 5, rebuilding, strengthened oversight, risk management overhaul, a renewed focus on ethical culture. From 1852 to today, one word defines the entire timeline: trust. Trust built Wells Fargo. Trust erosion damaged Wells Fargo. Trust rebuilding defines its future. Enhanced compliance frameworks, customer-first initiatives, transparent communication. Reestablishing confidence is not marketing, it's structural reform. Stronger board oversight, clear accountability mechanisms, improved risk controls, growth aligned with governance. Now the question becomes, can innovation return without repeating the past? The next decade will answer that. Today, Wells Fargo presents itself as a modern financial institution focused on technology, compliance, and long-term stability. But modern identity must be backed by disciplined systems. Banking isn't just about money, it's about confidence. It's about incentives aligned with integrity. If this breakdown helped you understand the real story, comment one word below: trust. And if you want a deeper dive into the scandal timeline, let me know you want part 2. Thank you for engaging in this journey through one of America's most complex banking stories. This presentation is for educational purposes only and does not constitute financial, legal, or investment advice. Please consult a qualified professional before making financial decisions. Research for this presentation draws from regulatory reports, enforcement releases, historical archives, and financial disclosures documenting the evolution of Wells Fargo.